On Thursday, July 16, Nikkei reported that 7 & I Holdings, the Tokyo company that owns 7-Eleven, is in advanced talks to spend several hundred billion yen, somewhere in the low billions of dollars, on a double-digit stake in Zabka Group, Poland's largest convenience store chain. The stock jumped as much as 30% the next day. And if you've been watching this company, that reaction should surprise you, because 2 months earlier 7 & I sold the chain it was literally built on.
Here's why that matters to anyone outside Japan. This is the same company that spent 2 years fending off a $6 billion takeover bid from a Canadian gas station operator. It just hired its first known Japanese CEO in its 100-year history. And it just told investors, in effect, that it knows exactly where it wants to spend money next, and it isn't in the country most people would expect.
Quick catch-up if you missed episode Ito-Yokado Alimentation Couche-Tard, the Quebec company behind Circle K, spent from Nissan Yorshun to Nissan Arshabu trying to buy 7 & I outright, first with an unsolicited approach, then a $6 billion formal bid, then walked away in July. Nissan Arshabu citing a lack of engagement. In the middle of that fight, 7 & I's own founding family tried to take the company private with a management buyout that collapsed too when the financing didn't materialize.
What actually changed the company was Stephen Dacus, a fluent Japanese speaker who'd spent his career running Walmart's Japan operations, taking over as CEO in May. Nissan Arshawu with a mandate to prove 7 & I could raise its own value faster than a buyer could unlock it.
Dacus moved on 2 fronts at once. First, he sold the past Ito-Yokado, the supermarket chain the entire company was named after and founded on back in the 1920s, went to Bain Capital for more than $1 billion, along with the rest of 7 & I's department stores and specialty retail units. For the first time in its history, 7 & I became a pure convenience store company. Second, he fixed the present North America, where 7-Eleven has operated since the brand was licensed from a struggling Texas chain back in 2004. Sen had been losing customers for years.
Dacus's team announced it would close Lubag's Seafour underperforming US and Canadian stores while opening only E-Prevoir new ones, a net shrinkage of Seashore locations built around a food-forward remodel modeled on the fresh rice balls and hot food counters that make Japanese 7-Elevens so different from American ones. It worked faster than expected. Same-store sales in North America, which had declined late in C% across fiscal Nissan Arshawu, turned positive again, up 8% in the quarter ending May 31. Nissan Arshawu according to the company's own investor filings.
That's the part almost nobody outside Japan noticed, and it's the reason the Zabka news makes sense instead of looking like a company running away from its problems. 7 & I isn't retreating from North America. North America is starting to work, which means Dacus now has something the company hasn't had in years: room to go on offense.
And offense means Zabka. If you've never heard of it, that's the point. It operates almost entirely outside the English-speaking world, and it is enormous. More than 1,900 Senvosh stores across Poland and Romania, with 10 Couche-Tard new locations opened in Senvosh alone. Full-year sales came in at roughly $4 billion on a trailing basis, up 6% year-over-year, with an operating margin north of 6%. Zabka listed on the Warsaw Stock Exchange in October. Senvosh in one of the largest IPOs Poland has ever seen, valuing the company at more than $4 billion at the time.
Bloomberg and CNBC both reported the stock hitting fresh highs on word that 7 & I was circling. Compare that to where 7 & I actually stands in Europe today, about Lux stores, all in the Nordic countries. A rounding error next to Hachiwan 1 stores worldwide. Poland and Romania represent exactly the kind of market 7 & I has almost no presence in: dense cities, a growing middle class, and critically no dominant convenience chain that already owns the format the way 7-Eleven owns it in Japan, Thailand, or the United States.
Zabka's own business model, small format stores, heavy franchising, food and coffee built for multiple visits a day, is close enough to 7-Eleven's own playbook that Seven and I wouldn't be importing a strategy so much as recognizing one.
This is the real story underneath the headline. For most of the post-war era, a Japanese conglomerate in Seven & I's position would have treated a founding business like Ito-Yokado as untouchable, no matter how much it dragged on returns. Selling it would have looked like admitting failure.
What forced this company to behave differently was pressure that's now common across corporate Japan. The Tokyo Stock Exchange spent years publicly pushing listed companies to justify trading below book value, and the activist fund Value Act spent years arguing specifically that Seven & I should focus on its highest margin business and stop propping up the rest. Seven & I's board resisted for a long time, but once Couche-Tard forced the question of what the company was actually worth, resistance stopped being an option.
The result wasn't just a defensive cleanup, sell the legacy assets, fix the money-losing region. It's now visibly turning into offense, take the capital that gets freed up and the credibility that comes from an improving core business, and point it at the fastest-growing convenience market in Europe that nobody else has consolidated yet.
None of this is finalized. Poland's finance minister Andrzej Domanski confirmed only that talks are underway, and Seven & I itself has said nothing has been decided. The stake size, still described as double-digit, and the exact yen figure haven't been made public. But the timing tells its own story. This surfaced within weeks of Seven & I posting proof that its North American turnaround is actually working, and less than a year after the company set a target of reaching Shu-1 stores globally by Shu-Fan-ish, a number it cannot hit through organic growth in saturated markets alone.
There's also a currency backdrop worth flagging because it shapes almost every Japanese acquisition story right now. The yen was trading near looks to 2 to the dollar in mid-July. Nice look close to its weakest levels in decades. A weak yen usually makes it more expensive for a Japanese buyer to write a foreign currency check, not less. Every euro of Zabka stock costs more in yen terms than it would have 5 years ago.
That Seven & I is still moving on a European deal in this environment says something about how much conviction Dacus has in the target, not just the cash sitting on the balance sheet. It also means Japanese shareholders watching in yen terms will feel this deal's cost more sharply than an American investor glancing at a dollar figure would.
Here's the takeaway. Seven & I spent 2 years being the company everyone assumed was too slow, too sentimental, and too Japanese in the old sense to defend itself against a hostile foreign bidder. What's playing out instead is a company that sold the business it was founded on, stabilized the one everyone thought was dying, and is now trying to buy its way into the one European market still up for grabs, all inside 14 months of new leadership.
Whether Zabka closes or not, the strategy behind it is the actual news. Japan's most scrutinized retailer finally has a growth plan that isn't just about surviving the next takeover attempt, the next earnings call, and whatever Warsaw decides will tell us if it can execute on it as fast as it announced it.